Hello and welcome to this week's show. Thanks so much for joining us today. I'm your host Trey Winowitz and you're watching Right on the Money. Our goal for the show is to always equip you, the viewer, with accurate financial information so you can make educated decisions for both you and your family. Now we've got a great show lined up for you today, so thanks for watching. We're going to be tackling some difficult financial questions, and we want to take some things that could be somewhat complicated and make them simple and easy to understand. So come on in and have some fun with us today.
In the aftermath of Hurricane Katrina, Trey Winowitz was forced to move himself and his family over 600 miles north and begin his financial planning practice again, from scratch. Since then, Winowitz Financial has become a national success story, establishing itself as a trusted source for financial advice in and around East Tennessee. In return, Trey gives back to the community by sponsoring monthly educational workshops and annual charity events. He also hosts a weekly radio show informing and entertaining those in need of financial advice. So, if you'd like to understand more about today's challenging financial environment, if you'd like to overcome your current financial situation, and want to learn from someone with a track record of overcoming, stay tuned for some trusted financial advice that's right on the money.
Now let's get to our main topic, red money versus green money. Today we're talking specifically about investing, what you can do with money that you already have to help it grow. When we're talking about investing, there are always lots of questions. People call in the office and come in for a portfolio review, and they often ask me for a second opinion about things that they've already purchased. Sometimes they want to know what else is out there that might be an option for them. Well, there are many types of investments, literally hundreds of them out there. But the good thing is you can generally put each of those investments into one of two categories, red money and green money. Guys, you realize this is pink, right?
Sorry.
Well, what we're going to do today is talk to you about all the different types of investments that you can make. Some of these are more risky financial tools, and others are more safe and protected. We're going to define each type of investment and then talk about the risks involved with each one of them. Some of them have investment fees, others don't. Some have a time commitment, while others have principal risk. I'll give you all the information so that you as the investor can decide what investment mix is right for you. Let me give you a little history behind this show. Working as a broker years ago, things always seemed to be in a little bit of a gray area. The economy was completely different back then. The market was way more consistent and way less volatile. With risk, it wasn't a huge concern for investors, and also it wasn't a huge concern what they paid for their advice. Advisors out there were trained just to spread out the risks. They really didn't show you as the investor how to eliminate it. Well, as you know, things are dramatically different today. So you want to be sure as an investor that you understand and know your different options available when it comes to investing your hard-earned money. So here's what we're going to learn on today's show. Number one, what are all the different types of investments that you could make to make sure that you're considering all your options? Number two, what are the differences between those investments? Number three, what are the potential problems with each? And then, how do you determine what's right for you? Remember, if you have a question about an investment that you own or an investment that someone's recommending, you can always give me a call or send me a question. We'll do our best to get it answered accurately and as soon as possible. Now let's take a quick break, and when we come back, we'll talk about all the different investment options that are red and green. I'll see you on the other side of the break.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Welcome back to Right on the Money. I'm Trey Winowitz, and we're talking about where to invest your money today. If you're looking for a place to make an investment in today's market, you basically have a few main categories. We're going to talk about 4 options before the next break, and I want you to understand that these are more risky options. Today we're going to call those red money tools that you can use for investing. For today's discussion and every day in my office, risk is going to be defined very simply. I don't ever want there to be a gray area for this. If you can lose your principal or interest, the investment is red. If the interest or principal is protected, the investment is green. And we'll start with the risk side first since it's more prevalent. Now, definitions we're going to use today are from Investopedia, which is a great online resource for investors. The first thing you could put your money in are individual stocks. A stock is a type of security that signifies ownership in a corporation. There are two main types of stocks, common and preferred. Some people love stocks for their high potential for gain. The potential problem is, though, they can go way up, but they can also go way down. Next on the list we have bonds, an investment which an investor loans money to an entity, that could be corporate or governmental, that borrows the funds for a defined period of time at a fixed interest rate. Bonds are also used by companies, municipalities, states, U.S. and foreign governments to fund a variety of projects and activities. Bonds are commonly referred to as fixed income securities, and there are three main types: municipal, corporate, and high yield or junk bonds. Some investors like bonds because generally they pay consistent interest and have less risk than stocks. But one potential problem is some advisors convince you that bonds are safe investments, but they definitely have some risks. Some risks of bonds are, number one, interest rate risk. That is, when interest rates start to rise, the value of the bonds will go down. Consider where we are historically with interest rates. Where do you think rates have a chance to go in the future? Another risk with bonds is credit risk, which is the risk of default. Has anyone ever heard of Lehman Brothers? They were AAA rated right before they went bankrupt, and all their bondholders lost tons of money. The tip of the day for bonds is typically the risk associated with getting your money back at maturity of the bond correlates with the interest rate. The higher the yield, the more risk as an investor you're taking. After stocks and bonds, the next category of investment tools on the risky side are mutual funds. Now, mutual funds are a combination of the previous two, stocks and bonds. These are investment vehicles that are made up of a pool of funds collected from many investors for the purpose of investing in securities. Securities are things such as stocks, bonds, money market instruments, and similar assets. Mutual funds are operated by money managers who charge fees and have basic investment philosophies that they have to stick to in the fund's prospectus. Since they're made up of stocks and bonds, they carry the same risks that stocks and bonds do. One advantage is it gives smaller investors access to professional portfolio management. But one potential problem is brokers' explanation of mutual funds. Over the last 10 years, Wall Street's conditioned us to buy more of them and spread out your money so somehow you can make it safe. The fact is that's just not true. All mutual funds have risks, that's why they're red, remember? So if you're looking for investments that are safer, stick around after the break. Next on the list on the red side is variable annuities. The word variable should give you a clue to the principal varying, or it's going up and down in value. These annuities are made up of mutual fund-like sub-accounts that drive the growth and could cause an investor to make or lose principal. Some investors buy them because they have death benefits and income benefits attached to them, but generally those come at a price. The potential problem I see with them is they generally have much higher fees than any other investments or annuities out there, and the principal fluctuates up and down with the market. By the way, some of these contracts also have market value adjustments and could be unsuitable for many older investors. Now, not all annuities are bad, but if you own a variable annuity, you owe it to yourself to bring it in and understand how the fees work. We help people every week discover and eliminate the fees, and I'd love to help you with your account if it's appropriate. So give us a call, we'll set up an appointment and walk through our annuity fee sheet with you and get you all the information. Most of the time it's way more eye-opening than you would believe. Well, so far we've covered 4 tools which are available to investors. All of them are red or risky. When we come back, we'll talk about one more type of red money as well as safer or green money tools for today's investors. These investments will protect your principal and your interest. So I know you'll want to hear about them, and I hope you can join us. So stick around after the break for more financial advice that's right on the money.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
Thanks for joining us. I'm Trey Winowitz and you're watching Right on the Money. Today we're covering two main categories of investments, red and green money. If you've missed any part of the show, please be sure to visit my website at treyw.tv. Also, if you have any financial questions that you want to have answered, post them on our Facebook page, tweet or email them to me. We'll do our very best to get them answered right here on the show. Now let's take a look at the next type of investment category, which in my opinion could help round out a balanced portfolio. These are alternative investments. Securities other than stocks and bonds. They could actually be real estate, precious metals such as gold or silver, or even some gas and oil investments. Now, typically these offer growth potential, but more importantly, dividends that are not directly tied to today's stock market. Some of these investments, like real estate, even receive special tax considerations and typically offer investors higher yields. These could be appealing to clients because they offer an alternative which does not move with the stock market. Potential problems, however, are historically, real estate and precious metals can be a more stable asset class. However, in some cases, the value could fall dramatically as well. The other thing that could be a problem is liquidity or access to your money. Now let's take a look at the investment tools available which do protect your money. Now we've been talking up to this point about some more traditional means of investing and what the related risks are for those. Now let's take a look at categories on the green side. First up are CDs. No, that doesn't stand for Certificate of Depreciation, it's Certificate of Deposit. CDs from the bank. They're a savings instrument entitling the owner to receive interest. A CD has a maturity date and a fixed rate of interest and can be issued in any denomination. CDs are generally issued by commercial banks and insured by the FDIC. The term CD generally ranges from 1 month to 5 years, and they're basically promissory notes issued by the bank. They're safe because of the insurance of the FDIC and great for short-term parking places for emergency money. However, in today's economy, they grow very slowly. Now, there are two main types of CDs. The more common is the fixed or a declared rate CD. For instance, you could earn maybe 1% for 5 years. But there are also indexed or market-linked CDs. These are gaining popularity in this low interest rate market, and they average about 3 to 5% return with a time frame of 5 to 10 years. There's a cap on the gains that are linked, not invested in a direct market index. But a potential problem of CDs is that you could pay a penalty if you take the money out early before the term. The last type of investment on the safe side are fixed annuities. These are contracts which an insurance company makes a fixed interest payment and the interest grows tax deferred to the owner for the life of the contract. The insurance company guarantees both interest and principal. But there are two types of annuities that are fixed, similar to CDs. The fixed or declared rate, which pays 2 to 3% maybe for 5 years. And then there's a market-linked or an indexed annuity. These are similar to index CDs. Average returns 3 to 6% and have similar time frames of 5 to 10 years with a cap on the gains when the market is up. Fixed annuities are guaranteed, however, by the insurance companies reserved, and also they're safe because they're backed by the state's guarantee fund. These annuities can also have other guarantees to ensure a lifetime income. Most investors like them because, like CDs, when the stock market goes down, you don't lose any money. However, potential problems. Agents sometimes try to sell long-term contracts for higher commissions. I've seen some agents try to advise you to put too much money in also, which would hinder your liquidity or access to your money. Give me a call and we can talk about some really good short-term options. Finally, some of them also have hidden fees and also market value adjustments. You want to make sure you understand all the features of your annuities. Our clients like to use them because they add true diversification to their accounts. These accounts are fully customizable for retirement planning needs and can help increase returns sometimes on low-yielding accounts. They're also used as an alternative to eliminate fees and risks of your portfolio. Bottom line for today's show, not all investment vehicles are made equal. You need to understand your options and meet with an advisor that's a member of the National Ethics Bureau and the Better Business Bureau so you can get an honest second opinion. Why don't you give us a call and set up an appointment? I'd be glad to sit down with you personally and explain all these options to you in more of a detail. Together, we can figure out the best plans for your investments. Coming up next, don't miss our Money Matters segment. I'll see you on the other side of the break.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Now that we're back, I'd like to tell you about some real-life folks that you may can relate to, because it never hurts to have an extra pair of objective eyes take a look at your situation and see what can be improved. Even if strategies that you're using can't be improved on, sometimes people say it's a huge comfort when I tell them that what they're doing is working well, or maybe they should continue on the same path. However, in some cases, we discover that some of the products or strategies they thought worked in a certain way actually don't. And sometimes not getting a second opinion can be very costly. If you want to be a part of this Money Matters segment, please give us a call at the office for a complimentary review. As you'll see, everything's kept confidential, but your situation may help some of our other viewers secure their financial future. So give me a call and maybe your case will get picked for the show. I want to take a second to introduce you to a few people who came in the office recently for a no-obligation second opinion, just to be sure. And these people were glad that they did. So let's take a look at this week's case. Hey, Janet, can you bring me my notes? Thanks. All right. All right, this week's case study comes from Knoxville, Tennessee. We have a 61-year-old engineer working still in Oak Ridge, and his wife is 60. She's still working as a nurse. They had just recently come to one of our weekly educational workshops. Their main concerns, protecting their 401ks. They both had 401ks that were really good from their existing employers, but they had seen a lot of volatility in these and were looking to see if there was a way to help protect those. The other thing is they had a goal to pay off their home in the next 7 to 10 years in the beginning stages of their retirement. And also they wondered when it was the best time to take their Social Security. So with all of these things, here were our steps to success. We sat down with them, and first we researched their 401k plans, looked at all of the existing options, and then we also looked at some of the rules. We compiled all their information on their existing mortgage loan and introduced them to our in-house mortgage professional to see if there was any other better options to help them pay that off sooner. Lastly, we analyzed with them, and we called Social Security, analyzed their Social Security benefits, and tried to formulate a plan to see if we could maximize those benefits for their family. The results. We actually discovered, and in most cases this is the case for a lot of folks that come in, there were in-service distributions allowed. What that is some employers' plans, 401ks, will allow you to roll over your 401k while you're still working. So we actually were able to do this with this couple and help find some safer, more protected alternatives with no fees so that they wouldn't lose any money while they were still working. Secondly, we shared with them a strategy on their mortgage, learned from our mortgage professional. We were able to refinance and actually pay their home off 3 years sooner. So that was a big help in improving their retirement plans. And lastly, we came up with a strategy to help them maximize Social Security benefits by postponing their benefits a couple of more years so that they could get more money for the future for the rest of their lives. Give us a call today for a complimentary review, and if your scenario gets picked for the show, you're going to receive a right-on-the-money prize pack. But most of all, we want to help you. Coming up next, another opportunity for you to be a part of the show. Post it on our Facebook, tweet us, or email us your financial questions, and stick around for the viewer mail section.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
Welcome back to Right on the Money. I'm your host, Trey Winowitz, and it's time for you, the viewer, to be an integral part of this show, Viewer Mail. This is the part of the show where you send us your questions about anything financial. In order to get your questions to me, you can post them on our Facebook page, tweet your question to me at TreyWTV, or email them to me at advice@TreyWTV. If your question happens to get answered for the show, you'll receive a Right on the Money prize pack just for your willingness to help out our other viewers. This package has a retail value of over $50, so please don't stop sending us those questions. Our first viewer mail question today is, I'm 63 years old and my bank is pushing me to buy a variable annuity since I told them I wanted to get out of the volatility of the stock market. It sounds pretty safe. What should I do, and is there anything that they're not telling me? Well, unfortunately, when people come into the office with annuities that they've purchased from other advisors or banks, a lot of times there's quite a bit of information either left out or not really explained thoroughly. In instances like yours, I'd say it's best to go in and meet with an independent advisor. If you were to come into my office, I'd take a look at your contract and then spend some time with you making sure that we knew the benefits of the contract compared to the cost of the account. More often than not, these type of accounts and the fees associated with them outweigh any perception of benefits. I would go through our annuity fee sheet with you while we were on the phone with the insurance company. That way we could determine if the suitability of that product fit with what your goals were. That's a great question, and I'd love to help you with that. Also, just for sending in that question, give me a call at the office and I'll send you a free copy of a DVD of our show on annuities. It details all the different options just to help you. Thanks for that Facebook post. And our next question is, what's a good plan for someone whose job doesn't take money out for retirement? Well, there are a lot of different retirement plans. Depending on what your business is, how much money it makes, and how much money you take out of it, etc. For you, I would say I'd be focused on finding one of these with very low cost or no fees for administration. This would allow you to focus on your highest rate of return, which would be growing your business. Depending on your risk tolerance, there's a lot of different platforms that you could look at, but you want to make sure that you're always picking one that fits with what you want and not what the advisor wants. A lot of times, small business owners can set up what's called a simple IRA plan. Traditionally, this lets them put as much money as necessary, especially if it's a fairly new business. Then, once you choose the retirement plan type, you can work together to find the appropriate investments to go inside of this plan. Give me a call at the office. In a short meeting, we can walk you through all of the options, and we can also talk about some great accounts with no fees. Thanks a lot for that question. The last question we have time for today is this. I have an extra $100. Should I put it into my 401k or save for my kids' college? You know, I think the answer to this question depends on a few factors. Does your employer have a match to your 401k? Do you already have an ample emergency fund established? And how old are your children? I'm a huge advocate for helping out your kids as much as possible, and I think we all want our kids to have more than we did. However, from a financial perspective, I don't want you to do things now that'll put you in a position that you'll have to work forever. I would encourage you to come in, sit down, and let's talk about your specific situation. We can work through the problem together and find a solution that's best for you.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
And we're back. This is Right on the Money, and I'm Trey Winowitz. We're just getting ready to wrap up the show, but before we go, I'd like to tell you about an old Louisiana tradition called lagniappe. Lagniappe means to give someone a little something extra, and the way that we want to do that here at Right on the Money is to brighten your day at the end of our show. So with that, here's a little lagniappe for you. 3 guys decide to play a round of golf. One's a priest, one's a psychologist, and one's an economist. They get behind a very slow twosome who, despite their caddy, are taking all day to line up their shots and 4-putting every green. By the 8th hole, the 3 men are complaining loudly about the slow play ahead, swearing up and down and on a blue streak. The priest says, "Holy Mary, I pray that they should take some lessons before they play again." The psychologist says, "Man, I swear, there's people that play like, I didn't know there's people that play golf so slowly." The economist says, "Man, I really didn't expect to spend this much time playing a round of golf." By the 9th hole, they've had it with the slow play. So the psychologist goes up to the caddy and demands that they're allowed to play through. Caddy says, "Okay," but then he explains to him that the 2 golfers are both blind, retired firemen who lost their eyesight saving people in a fire, and that's why they're playing so slow. Also, he says, "Look, could you please not swear or complain so loud?" The priest was mortified. He says, "Hey, I'm a man of the cloth. I've been swearing at the slow play of 2 blind men." The psychologist was mortified. He says, "Here I am trained to help others with their problems, and I've been complaining about the slow play of 2 blind guys." And the economist ponders for a moment and thinks about it. Then he finally goes back to the caddy and says this, "Listen, next time, couldn't you just let the guys play at night?" And that, my friends, is your little lagniappe for today. That's pretty terrible. I want to personally thank you for watching our show today. I hope you found our show helpful as well as a little bit entertaining. If there's anything at all I can help you with financially, please don't hesitate to call our office. And remember, any plan that we come up with will always have 3 main goals for your money. Safety first, or protection of your principal, is always number 1. Making a reasonable return on your money in what some would consider an unreasonable market. And number 3, keeping your plan simple and easy to understand. If that sounds like something you want, I know I can help you. Also, please keep the financial questions coming. We'll do our best to get them answered on the show. I'll see you next week at 3 o'clock for more trusted advice that's right on the money.